So let's say that you're successor trustee of a special needs trust. First year, you have to file taxes. How are special needs trusts taxed? How does that even work? In this video, we're going to address that question because, as Benjamin Franklin once said, there are only two things in life that are certain: death and taxes. So before we talk about income taxes, I want to make sure you know that I am not a specialist in income taxes. I know just enough to be dangerous, okay? Estate planners typically specialize in 5 different types of taxes: in estate taxes, gift taxes, generation skipping transfer taxes, capital gains taxes, and California property taxes. We don't specialize in income taxes. For that, you would go to your CPA or your accountant or enrolled agent, and they would help you prepare your income tax returns. But one challenge is to find an accountant who really specializes in special needs trusts, and I've really struggled to find one here in the Bay Area. So I'm going to give you as many tips as I can, and again, talk about it with your accountant. Okay, so I'm going to give you an example of a trust. Let's say that there's a special needs trust that has $500,000 in it, and that money is being invested and managed, and let's say there's $30,000 of dividends every year. What happens to the tax on that $30,000 worth of dividends? Well, one challenge that we have is that most special needs trusts are what we call non-grantor trusts. That means that they're taxed at the tax rate, and the tax brackets for irrevocable trusts are compressed. So if the trust is only generating about $13,000 or so of dividends, that's going to be taxed at the highest rate, which right now is 37%. Compare that to a single person, and that person only hits that 37% threshold when they have up to about $550,000 of income taxes. So you can see we don't want things taxed to the special needs trust if at all possible. So let me break down how this works, and you can see how we can avoid or minimize the income tax exposure. So the first thing you need to do is figure out, what type of trust am I talking about? Is this a first-party special needs trust or a third-party special needs trust? Because a first-party special needs trust holds the beneficiary's own assets. The beneficiary is the first party. It's holding their money, okay? That is taxed differently than a third-party special needs trust, which holds the beneficiary's money, but somebody else has put the money in. So it's a different source. The third party is funding that trust. So the first party special needs trust is really kind of the most straightforward, because that's going to be taxed at the individual's tax level. Isn't that cool? Now, you can get a tax ID number for a first party special needs trust, and in fact, I usually recommend that. But sometimes people just use the beneficiary's own social security number, because really that money is just taxed to the individual, which is really good because most disabled people, this part isn't good, right? Most disabled people do not have a lot of income. But the good thing then is that they're in a lower tax bracket. So that's pretty straightforward. Okay, but a third-party special needs trust, that one's a little bit more complex. How does that work? Within the category of a third-party special needs trust, we find 2 different types of trusts for tax reasons. It can either be a qualified disability trust or a complex trust. So here are the requirements of a qualified disability trust. So the trust must be irrevocable. Another qualification is that only disabled people can be beneficiaries of that trust. And by disabled, we mean they're receiving SSI and or SSDI. So the beneficiaries must be disabled. And also, the beneficiary must have been under age 65 when the special needs trust was established or funded. So if your trust qualifies as a qualified disability trust, there's some tax benefits to that, because qualified disability trusts receive a $4,400 tax break. There's an exemption from income taxes of that amount. So a complex trust is really any other type of third-party special needs trust that doesn't fit those requirements. The reason why it's a complex trust and not a simple trust is because the trustee has discretion over the income and principal payments. A simple trust is where all the income goes out to the beneficiary all the time, which is not what we want for a special needs trust, right? It wouldn't qualify as a special needs trust for that. So for that reason, just about all third-party special needs trusts are complex trusts. Now, complex trusts only get a $100 exemption amount each year. So you can see, from a tax perspective, it's better for a third-party special needs trust To be a qualified disability trust, you get a larger exemption than to be a complex trust. Okay, but let's circle back to this really big question that I raised earlier, that we have this $500,000 special needs trust that's been funded, and let's make it a third-party special needs trust, and there's $30,000 of dividends of income that have been generated. How is that going to be taxed? Well, in this example, let's say that $20,000 of that was used to pay for things for the beneficiary. So basically, that money, that $20,000 of payments made for the beneficiary, that is reported on the beneficiary's income tax return under a K-1 form, and that is taxed at the beneficiary's low tax bracket. The $10,000 that was retained in the trust, that's taxed at the trust tax bracket on the 1041. So the way I think of it, somebody needs to report the income. If the income stays in the trust, it gets taxed to the trust. And if the income goes out and is used for the beneficiary's benefit, then it's taxed to the beneficiary. Now, some people really worry, hold on, if this is being reported as income for the beneficiary, isn't that going to interfere with SSI? And my answer is no. As long as those payments are being made on behalf of the beneficiary, but not actually cash being distributed directly to the beneficiary, then it doesn't count as income for SSI or Medi-Cal. But it does count as income for income tax purposes. So it has a different definition each time. All right, so we've determined that $20,000 went out of the trust for the benefit of the disabled person, and $10,000 was retained. How is that $10,000 taxed? Well, that's where we look to see, is it a qualified disability trust or is it just a complex trust? If it's a qualified disability trust, $4,400 of that $10,000 is exempt, and then it's taxed at the trust tax bracket for that rest of the $5,400. Okay. Now compare that to a complex trust where only $100 is exempt, and that other $9,900 is taxed at the tax bracket level. So that's usually at a higher level than the beneficiary. So you can see it really makes sense, especially towards the end of the year, for the successor trustee and the accountant to meet together and to say, all right, well, how much income is generated, or they can meet with their financial advisor to determine this, how much income will be generated by the end of the year, and try to have that match up as closely as possible to how much has been distributed out for the beneficiary, because then all of the income generated will just be reported to the beneficiary. Now you can see there's several players here, right? There's the person who set up the special needs trust and helps advise on it. That's the estate planning or special needs planning attorney. Then you have the financial advisor who's making sure that money is being managed and invested the way the grantor really wanted. And then you have the accountant who's working to file the income tax returns and make sure that things are reported correctly. This is kind of the trifecta in estate planning. These are the three team members that you'll want. So hopefully that summary of how income taxes work is quite helpful to you. This question especially comes up shortly before people are filing tax returns, and I get a slew of questions, so I'm really hopeful that this will be a good resource. So now you know how your special needs trust will be taxed. So I invite you to go see this video over here on how to set up a special needs trust in California.